It is the first rule taught to every novice trader, a mantra repeated in every textbook. The stop loss is your shield, a non-negotiable mechanism of self-preservation in the chaotic theater of the markets. Yet, here is the clinical reality. That very shield, the tool designed to protect, is frequently forged into a target. The logic is a paradox, a safety net that actively attracts the predator. Within the first 30 seconds of this analysis, we will observe a market event that defies conventional logic. A security, trending upwards with stable momentum, suddenly plunges on immense volume. It drops precisely 15 ticks below a critical support level, only to reverse course with impossible speed, closing the session at a new high. The casualties were not random. They were a cluster of traders whose shields were deployed in exactly the same location. Their protection became their undoing. To understand this phenomenon is to peer behind the curtain of price action, into the cold, calculated mechanics of market liquidity. This is not a conspiracy. It is a clinical dissection of the market's most efficient and most misunderstood trap. The stop-loss order, in its purest form, is a dormant market order. It lies in wait, an instruction to sell at the prevailing market price if a specific, less favorable price is reached. For a long position, this is a stop-sell order. For a short position, a stop-buy. Its purpose is to cap losses, to enforce discipline where emotion might fail. On the surface, its logic is unassailable. It automates the single most difficult action in trading, admitting a thesis is wrong and liquidating the position. Traders are taught to place these orders at technically significant levels, just below a recent swing low, under a well-established support line, or a calculated distance from a moving average. The shared knowledge from thousands of books, courses, and seminars leads to a predictable, herd-like behavior. This congregation of intent creates something invisible on a standard price chart, yet intensely visible to those with the instruments to see it. It creates a liquidity pool. Imagine a vast, deep reservoir of market orders, all clustered around a single, precise price zone. For a large financial institution, a market maker, or a high-frequency trading fund that needs to execute a massive order, this reservoir is an irresistible opportunity. Attempting to sell, for example, 100,000 shares on the open market would create a significant price impact, a downward pressure that worsens their own fill price. This is slippage, the enemy of institutional execution. But if they could engineer a situation where 100,000 shares worth of buy orders suddenly entered the market to be sold into, the problem of slippage would be solved. The stop-loss orders of retail traders, when triggered, are not polite requests. They are market sell orders, demanding to be filled at any available price. They provide the exact liquidity the institution needs. But the real power of this mechanism is hidden in a parameter most traders ignore, the concept of inducement. To understand how this shield becomes a magnet for predation, we must first dissect the anatomy of the market's invisible hunters. These are not malicious actors in a narrative sense. They are rational agents operating within the market's framework to maximize their objectives. Their primary concern is not predicting the direction of a trend, but the efficient acquisition and distribution of vast inventory. Their tools are different. While a retail trader sees lines on a chart, an institutional desk sees a comprehensive map of the order book. They possess data feeds and analytical systems that reveal the depth of market, showing not just past prices, but the current landscape of resting orders. They can't see an individual's specific stop-loss, but they don't need to. They see the aggregate. They see the herd, clustered predictably behind the flimsy fence of a textbook support level. The process of a stop run is a feat of market engineering. It begins with the identification of a significant stop-loss cluster. This is typically found below a clean low or above a clean high, where price has reversed multiple times, reinforcing the level's apparent strength in the minds of retail participants. The more obvious the level, the larger the pool of liquidity resting just beyond it. The next step is to drive the price towards this zone. This can be accomplished by absorbing buying pressure or by initiating a series of aggressive sell orders, often executed by algorithms designed to disguise their intent. The goal is not to start a new trend, but to create a short, sharp shock, a surgical strike on the price. The movement appears aggressive and decisive, designed to create fear and panic among traders watching in real time. As the price pierces the critical level by a few ticks, the first stop-loss orders are triggered. These dormant orders instantly become live market sell orders. This new, sudden wave of selling pressure pushes the price down further and faster, triggering the next layer of stop-losses just below. A chain reaction ensues. It's a cascade, a self-fulfilling avalanche of forced selling, entirely fueled by the protective orders of the retail crowd. In this maelstrom of forced liquidation, the institutional player, the entity that initiated the move, now switches its role. It becomes a buyer. It quietly absorbs the massive volume of sell orders being dumped onto the market, filling its large position at prices it helped engineer. Once the stops are cleared out and its order is filled, the artificial selling pressure vanishes. The price, now free from the downward force, often snaps back with incredible velocity. The theory is compelling, but the logic is only validated through forensic analysis. We now place a specific market event under the laboratory microscope. Case study number 734. The subject is a major foreign exchange pair, Euro versus the United States dollar. The date, a Tuesday in October, 2023. The time, shortly after the London Open at 8 in the morning, Greenwich Mean Time. For 3 consecutive days, the price had found solid support at the 1.0550 level. Each dip to this price was met with strong buying pressure, creating a clear, unambiguous horizontal support line on the hourly chart. This is a textbook setup for a long entry. Retail logic dictates placing a buy order near this support, with a protective stop-loss placed just below it. A common placement would be in the 1.0540 to 1.0545 range, allowing for a small margin of error. At 9:15 in the morning, the price begins to drift down towards the support level on decreasing volume, a sign that selling momentum is supposedly waning. At 9:27, the dynamic shifts violently. In a single 1-minute candle, the volume explodes to over 500% of its recent average. The price plunges through the 1.0550 support level without pausing. It continues down, slicing through 1.0545, then 1.0540. The wick of the candle bottoms out at precisely 1.0538. Then, just as suddenly, it reverses. Within the next 2 minutes, the price rallies back above the 1.0550 support line. By the end of the hour, it is trading at 1.0580, far above the initial point of entry for the trapped bulls. The chart leaves behind a brutal signature, a long, piercing wick, a gravestone for the accounts that were liquidated in that 2-minute window. A forensic analysis of the volume profile for that period reveals the truth. The peak volume, the absolute epicenter of transactions, did not occur at the top of the move or in the middle. It occurred in the narrow band between 1.0538 and 1.0545. The exact zone where the stop-loss orders were clustered. This was not a trend change. It was a liquidity harvest. Observing the trap is one thing. Disarming it is another. The key lies not in abandoning the stop-loss, but in re-engineering its logic. A logical defense against such predation begins with rejecting predictability. If the herd places its stops at the obvious technical level, the intelligent trader must place theirs where the herd does not. The first countermeasure is spatial displacement. Instead of placing a stop a fixed number of pips below a low, one might use a volatility-based metric, like a multiple of the average true range, or ATR. This adapts the stop distance to the market's current volatility, placing it in a zone of statistical improbability rather than a zone of predictable congregation. The second countermeasure involves confirmation, a shift from price-based triggers to time-based validation. Instead of a hard stop order that is triggered by a fleeting price wick, a trader might employ a rule-based mental stop. For instance, the rule might be, I will exit my position only if an hourly candle closes below the support level. This tactic concedes a potentially larger loss if the level truly breaks, but it provides immunity to the quick, violent stop runs that are designed to hunt liquidity and immediately reverse. This approach, however, introduces significant psychological risk and requires immense discipline, as it removes the automated safety net. A third, more advanced concept is to analyze the market from the predator's perspective. Before entering a trade, one must ask, where is the liquidity? Where would the obvious stops be placed? By identifying these zones, a trader can choose to avoid them entirely, waiting for a stop run to occur as a potential entry signal, a technique known as trading the liquidity void. This is the essence of graduating from a reactive participant to a strategic analyst. The market is not a random walk. It is an adversarial environment, a complex ecosystem of competing interests. The price chart is merely the surface layer, the visible outcome of a deep, unseen battle for liquidity. The stop-loss is not a fire-and-forget weapon. It is a sophisticated tool that, when deployed with a shallow understanding, becomes a liability. Its correct use requires a clinical awareness of the market's underlying structure and the motivations of its largest participants. The logic is clear. To protect oneself, one must first understand the hunter. The laboratory's work is never finished. New market structures and algorithmic strategies constantly evolve. To continue your dissection of the market's hidden mechanics and to sharpen your own analytical framework, subscribe to TradeLogic Lab. The analysis continues.